Hello, my dear future Chad accountants. This is Sheikh Mahagde, your learning partner for CA Final, FR, and SFA. Let us continue with FR upgradation classes. Today is going to be a very quick day because this session is not the topic what we're covering is not a detailed one. We'll begin. Just to remind you, the material for these sessions are available in my Telegram channel at CH Mahagde. Link is available in the description. Please download from the Telegram channel. These sessions are not a substitute for conceptual classes, neither regular class nor crash course class. This is just an attempt to cover the updated problems by ICAI in the new study material, RTP, MTP, previous year question papers, and so on. So we had done till Ind AS 115, revenue from contract with customers. Today we'll focus on Ind AS 8, that is accounting policy, Ind AS 10, event occurring after balance sheet date, and Ind AS 113, that is fair value measurement. And in fact, Ind AS 10, I don't have any upgraded questions. So effectively today we'll be covering only Ind AS 8 and Ind AS 113. Let us begin. A carpet retail outlet sells and fits carpets to the general public. It recognizes revenue when the target is when the carpet is fitted, which and on average 6 weeks after the purchase of the carpet. So, you carpet retail outlet sells and fits carpet sales to general public. Okay, so basically, the sale is towards sale of carpets, and it will take 6 weeks for you to install to fit the carpet, and after 6 weeks you will recognize revenue. It then decides to subcontract the fitting of the carpets to self-employed fitters. Instead of you doing yourself, you are giving it to somebody else. It now recognizes the revenue at the point of sale of the carpet. Whether this change in recognizing the revenue is change in accounting policy as per provisions of Ind AS 8. Now, Ind AS, accounting policy, keep it in mind, it is much broader than what used to be in the accounting standards. It's not just an accounting policy or method of applying those policy. Any series of principles, conventions, methods followed is called as accounting policy. So you are recognizing earlier, the accounting policy was recognizing earlier after complete fitting. And now, the moment you sell, you are going to recognize revenue. So on the face of it, if you observe, it looks like a change of revenue, a change of accounting policy, because earlier you were waiting for installation, now you recognize at the beginning itself. It's a change in accounting policy. But you should also look at the circumstances which led to this change. What the standard says, if the basis or if the circumstances, situation were changed earlier to now, then accounting policy is not called as change in accounting policy. See, earlier, let's say a software company was providing outsourced services, and now a software company makes their own products and services. You see, their nature of service is changed. The accounting policy is not called as change in accounting policy, because when the circumstances were different, the policy can be different, and it is going to be introduction of policy and not a change in policy. When new thing comes, it's not a circumstances that were there earlier. Keep it in mind, the primary purpose of the change in accounting policy, and change in accounting policy results in retrospective application. That means we are going to change the previous year financial statements for the purpose of comparison. So the circumstances were same. Earlier I was following one policy, now I follow one policy. So to make the users understand what is the impact previously also, I have to give a retrospective effect. But when the circumstances are different, This policy cannot be applied same in both the situations. That's what we say. The accounting policy is not a change in accounting policy. There is no change in accounting policy as retailer has changed the way the carpets are fitted. Earlier you were doing it yourself. Now you are outsourcing it, which means the circumstances have changed. And when you change the policy, because of circumstances, because of the situations that were prevailing in that point in time, it is not called as change in accounting policy, and there is no retrospective change, retrospective effect required. Only prospective effect. Going forward, you do the things as per the new policy. So introduction of a policy is not a change in policy. When is the entity required? When is the entity required to present third balance sheet as at the beginning of the preceding period? This is a very common question actually. You would have discussed many times even in Ind AS 1. So whenever there is a retrospective effect, which means the decisions might have been taken in the current year to change something, like change the accounting policy. Retrospective means if the same change was done earlier, what would have been the values then? That is, current year changes have taken place, current year financials will reflect it. But previous year financial also should be modified, not the previous year financial statements, previous year comparative, so that a comparison can be made between the change and the current value. And going one step further, even beginning of the preceding period, effectively you will prepare 3 columnar statement, at least in the notes to accounts. And that is what this requirement is. Let us see when effectively whenever there is a retrospective change, then it is required. Now let's quickly go through institute solution. So as per paragraph 40 of Ind AS 1, an entity shall present the third balance sheet at the beginning of preceding period in addition to minimum comparative statement if it applies accounting policy retrospectively, change in accounting policy from before to weighted average, makes a retrospective restatement of items in statements or reclassifies items in financial statements. Earlier it was a short-term loan, now it is classified as a long-term loan. Or for the purpose of comparison, previous year it was shown as a part of outstanding loan, or it was part of payable within 12 months and it was current liabilities, and remaining is long-term liabilities, current portion of long-term debt. Now once current liability is paid, that will go out, but this year that long-term loan becomes short-term loan payable within 12 months. So this year you can't show current loan, and previous year comparison you can't show long-term loan. The comparison amount should be taken out and shown as current loan, current liability for the purpose of comparison. Retrospective restatement or reclassification. Earlier you were showing it as expense, P&L account under administrative expenses. Now you want to show it under sales and promotion expenses. Any of that sort. The retrospective application, retrospective restatement, classification has a material effect on the information you have to provide the beginning of the preceding period. It's a simple statement, nothing complicated here. Is change in depreciation method for an item of property, plant, equipment a change in accounting policy or a change in accounting estimates? Many misconceptions are there. That is because some years back, like when I was reading and all, the change in accounting, the change in method of depreciation, straight line method to WDV or WDV method to straight line method, these things were considered as change in accounting policy, and we used to give retrospective effect, and we also used to calculate a surplus depreciation, surplus deficiency, etc. These used to be some calculations earlier. But now AS as well as Ind AS have changed, but some people not yet changed. As usual, for some people change is difficult. Change in method of depreciation. Let me make it very clear. It is change in estimate. What is the reason? Because now the policy is to adopt a cost model versus revaluation model. That is accounting policy, and if you change the cost model to revaluation model or vice versa, that becomes change in accounting policy. Everything else comes within that, and that will be accounting estimate. Number of years estimation, depreciation, useful life, scrap value estimation, useful life estimation. So all these are estimations, right? Earlier also. So depreciation method is also an estimate this year how much of the asset has been consumed, how much of the value of the asset has been reduced. It's an estimation after all, right? Not a method as such. It's the way in which you use the asset, and that's how you estimate. Therefore, it is a change in estimate and not change in policy. Let's quickly go through what Institute has told as the answer. As paragraph 60-61 of Ind AS 16 property plant equipment, the depreciation method shall reflect the pattern. Depreciation method shall reflect the pattern. Use these technical words in examination. You get good marks. What is the technical word? Reflect the pattern. Pattern. Remember the word pattern, in which assets' future economic benefits are expected to be consumed by the entity. Depreciation method applied to an asset shall be reviewed at least each financial year, and therefore has been a significant change in expected return of consumption in future economic benefits embedded in the asset method shall be changed to reflect the change pattern. Again, pattern. Such a change is accounted as change in accounting estimate in accordance with AS 8. As per the above, depreciation method for depreciable asset to reflect the expected pattern of consumption of future economic benefits embedded in the assets. Determination of depreciation method involves accounting estimate, and thus depreciation is not a matter of accounting policy, that is useful life, the economic pattern, economic benefits, and the consumption pattern, all those things. Accordingly, Ind AS 16 requires change in depreciation method as accounted as a change in accounting estimate prospectively and not a policy change and no retrospective effect. Straightforward thing. Let's move on. An entity charged off certain expenses as a financial cost in the financial statements for the year ended 2001. Some expenses are charged off as financial costs like interest, some commission, some loan processing fees, some expenses. While preparing the annual statements for the year ended 31st March 2002, management discovered that these expenses should have been classified as other expenses instead of finance cost. So they thought it's a finance expenses. Maybe the accountant went in the auto to submit all the loan documents. So you classified the auto charges as finance cost. But later you found out he went to the auto, he took the auto and somewhere else, he did not go to the bank and he submitted the document some other day. So which means the auto charges originally classified is other expenses and not towards finance expenses. I mean, just an example I told you. Many other situations like this can happen. So these expenses should have been classified as other expenses instead of finance cost. They wanted to make a change. The error occurred because the management inadvertently misinterprets certain facts. Misinterpretation. So it's a genuine mistake. The entity intends to restate the comparative amounts for the prior period in which the error occurred. So retrospective change they want to make it. Would this reclassification of the expense from the finance cost to the other expenses in the comparative amounts considered to be correction of an error under Ind AS 8? Would the entity need to present third balance sheet? Okay. Now error arises when there was a situation but you overlooked it. Change in estimate situation happens when you just estimated that was not under your control at that point in time. You had information, but you misinterpreted, you did not make use of it, that becomes a mistake. But you are not having, some estimations are required. For example, useful life of a asset. You estimate it to be 8 years. Now it's happened to be 4 years. It's not a mistake, it's not an error because the circumstances have changed after that. But here there is a facts and the facts were understood differently, misinterpreted inadvertently, which means they were having the information earlier. So obviously it qualifies for error. That's in my opinion. Let's see what institute says. But is a restatement required? That depends on material effect of error. If the error is so much material that we are changing the error now, we are rectifying the error now, and such rectification will change the previous year financial statements also materially. So user should be aware of it. Then we do retrospective change, reclassification. We prepare third balance sheet. If it is not material, then you don't have to worry about preparing any third balance sheet for the year. Let's see what institute says. Para 41 of Ind AS 8 state as follows: errors can arise in respect of recognition, measurement, presentation, or disclosure. Obviously, those are the four components of standards. Any standards of elementary statements. Financial statements do not comply with Ind AS if they contain certain mathematical errors or immaterial errors intentionally attribute a particular presentation of an entity's financial position, financial performance, cash flows. Okay. Potential current period errors discovered in that period are corrected, therefore, before management are approved for issue. However, material errors are. What are material errors? Material errors are sometimes not discovered until subsequent period, and these period are corrected in the comparative information retrospective effect in the financial statements of the subsequent period, and in that case, the third balance sheet is required. In accordance with the above reclassification of expenses, finance costs or other expenses would be considered as correction of an error under Ind AS. Accordingly, financial statements for the year ended for comparative amounts for the year ended would be restated to reflect the correct reclassification. So basically, you have to restate. Ind AS 1 requires an entity to present a third balance sheet at the beginning of the preceding period in addition to minimum comparative information. If inter alia, it makes a retrospective restatement of an item as statements and restatement of a material effect. Please note this point, Your Honor. It's a material effect on the financial information in the balance sheet. In the given case, retrospective relevant items in P&L account has no effect on information balance sheet. Therefore, the entity is not required to present third balance sheet. Okay. So when you change the P&L account, P&L account changes, right? It's just a movement from financial expense to other expenses. Profit does not change. Reserves and surplus does not change. So only the P&L account comparative, instead of showing in financial cost, you show it under other expenses. So only P&L account changes, balance sheet does not change. So preparation of opening of the balance sheet, no change. Earlier also same thing, now also same thing, not required. Okay, moving on. In 2003-4, X3, X4, after entities 31st March 2003 annual financial statements were approved for issue, a latent defect in the composition of new product manufactured by entity was discovered, or defect in the component was discovered after the year 2-3 are finalized. Wherein 3-4, that is a defect that could not be discovered by reasonable or customary inspection. So at that point in time, by putting the reasonable efforts, you are not able to identify this defect. And this year, you identify the defect relevant for the earlier year. Okay. As the result of latent defect, the entity incurred 1 lakh in unanticipated cost for fulfilling its warranty obligation in respect of sales made before 31st March 2003. So sales made before 31st March 2003, and at that point in time, based on the experience you had till then, you made a provision for warranty. That year is closed. Now you come to the next year, 2003-4. Now you found that in the product you sold there is a defect, and this defect was not identified earlier, and you could not have identified by reasonable efforts, which means it is not an error, it is not a mistake on your side, which you could not have predicted this warranty obligation. This year you have identified, and now you have to make an obligation in respect of previous year. Is it a prior period expense? Is it an error? Is what they're asking. An additional 20,000 was incurred to rectify the latent defect in the product sold during the year 3-4 before the defect was detected and the production process rectified. 5,000 of which relates to the item inventory on the 31st March 2003. Quite a few things have taken place now. One, rupees 1 lakh, which is warranty obligation relevant to the products sold during the previous year, identified in the current year. Second, you have incurred 20,000 this year, 3-4, to rectify some defects. Of the 20,000, 5,000 rupee relevant to inventory, which was there at the beginning of the current year or the previous year inventory. Of that, 5,000 rupee expense was related. Basically, 15,000 I can say for the current year. The defective inventory was reported at a cost of 15,000 in the year 2-3 in the first statement. So when previously we have taken, 15,000 was the inventory cost. When its selling price less cost to complete, and the sale was estimated at 18,000. The accounting estimate made in the preparing 31st March 2003, the financial statements were appropriately made using all reliable information that entity could reasonably expected to have. Please note this point, use these technical words, reasonably expected to have, reasonably expected, use these terms in exam, to have been obtained and taken into account in the preparation and presentation of those financial statements. Analyze the above situation in accordance with relevant Ind AS. Okay, quite a few things are there. Just read the problem once more. Let me explain. Then we'll look at what institute says. Please read it for 2 minutes. Okay, now let me explain the process, what to be done. We are in the year, okay, let me write down few things. Okay, so we are in the year 2003-4, X3, X4. I'll write for convenience 2003-4 and 2002-2003. Okay, now during this year, some products are sold. And these products are having some defects identified in 2003-4. These defects identified in 2-3-4, and previous year accounts are also completed. That is after the accounts were approved. So 2002-3 accounts were also approved. And because of this defect, there is a warranty obligation of 1 lakh. additional warranty obligation of 1 lakh. Now, should it be retrospectively given effect? Is it a case of prior period error? For that, you should write the definition of an error in the exam. An error here means, as per Ind AS 8, whether there was any mistake that the informations were there or reasonably expected to get those informations while making the interpretations, adjustments in the accounts. But in this case, they have given the data which we had, or this defect could not be discovered by reasonable or customary inspection. So, what circumstances prevailing them, you could not have identified this defect. So, it is not a prior period item, not a error. So, not a prior period item. And accounts are also approved. So you are going to recognize in the current year, and this will be recorded as a change in accounting policy and no, not in policy, change in accounting estimate and no retrospective effect. So change in accounting estimate. Okay, so this is one part of the problem. One more part of the problem, let me read. An additional 20,000 was incurred to rectify the latent defects in the product sold during 3-4 before the defect was detected, and the production process rectified 5,000 of which relates to item of inventory on 31/3/2003. The defective inventory was reported at a cost of 15,000 and sell was estimated at 18,000. Now this inventory, opening inventory, need to be rectified. So restatement, or whatever you call rectification, or revised value of inventory, cost on 31/3/2003. Cost is, they said, reported a cost of 15,000, and NRV. How do you in NRV? NRV, estimated selling price less a cost expected to sell. See, 31/3/2003 is the inventory, but this expense incurred in 2003-4. So current year. But the inventory, I am talking about the opening inventory. So expected to sell, expense incurred on sales expected to have, or expense expected to be incurred to sell the product, or any expenses to make the product saleable, everything. So 5,000 is relevant for these expenses. So 18,000 minus 5,000, and then we becomes 13,000. Whichever is lower, this should be valued 13,000. And this remaining 15,000, that will be relevant for the inventory. Since they are sold, that will be part of current year cost of goods sold. If something inventory is yet to be sold in current year, that will be part of current year closing stock. You don't have to worry about that. So this is only regarding the inventory which was there at the beginning of the year, and now we have to rectify it. Now we have to change it. Okay, let's see what institute tells. Ind AS 8 is applied in applying accounting policies, changes in accounting policy, changes in accounting estimates, and corrections of prior period errors. A change in accounting estimate is adjustment of carrying amount of an asset or liability, or the amount of periodic consumption of an asset, means depreciation. The change in accounting estimate is an outcome of assessment of the present status of the expected future economic benefits and obligation associated with assets and liabilities. Change in accounting estimate results in new information or new developments, and accordingly are not correction of errors. Further, the effect of change in accounting estimate shall be recognized prospectively, and these things we know it, by including a profit and loss, the period of change, if the change affected that period only, the period of change in future period, if it change affects both. Prior period errors are omissions from misstatements, entities' financial statements for one or more prior period, from the failure to use inadvertently to misuse reliable information that was available when the financial statements was approved for issue, or could reasonably expected to have been obtained. The information was available, or you could have got it. Taken into account presentation and preparation of our statements. On the basis of the above information, the details would be dealt as follows. The defect was neither known nor reasonably to detect 31st March 2003 before the financial statements were approved for issue. So, understatement of the warranty provision and overstatement of inventory 2000 in the financial statements are not a prior period errors. We are not going to give retrospective effect, we give only prospective effect. The effect of the latent defects relate to the entity's financial statements 31st March 2003 are changes in accounting estimates. In preparing the financial statement 31st March 2003, the entity made the warranty provision and inventory valuation appropriately by using all reliable information that the entity could reasonably expected to have obtained and taken into account the same presentation of statements. Consequently, additional costs are expensed calculated for the 2003. For what I explained only, it is there. They said the 2000 overstatement. Let me tell you what is that. We are valued at 13,000, right? Whichever is less, cost in RV, but actual cost would have been 15. So you would have valued 15,000. It was supposed to be 13,000. So 2,000 is understatement. We are reporting at a higher value, I mean overstatement. We have to report less. We are not going to change the previous year financial statements. No comparatives will be changed. Only current year opening inventory will be changed, and current year reserve surplus we are going to make an effect. So we are not going to show any changes as far as previous year financial statements, even for the comparatives, are concerned. Hope you understood. Let's move further. Okay, I think that is with respect to Ind AS 8. With respect to Ind AS 10, we don't have any additional problems. So Ind AS 10, we are not doing any problems. Let's go to Ind AS 113. I think we have only one problem. In days 113 also we don't have much of problem. So let's do this. In days 113, we only have one problem. Let's do this. Investment 1 is a contractual right to receive rupees 800 in 1 year. There is an established market for comparable assets, and information about those assets, including the price information, is available of those comparable assets. Investment 1 is a contractual right to receive 800 after year 1. So you are going to receive rupees 800 after year 1. So we should do present value of it. Investment 2 is a contractual right to receive 1200 in and as a market price of 1083. Investment 3 is a contractual right of 700 in year 2 and as a market price of 566. all the three assets are comparable with respect to risk, that is in dispersion of possible payoffs and credit, you require to measure the fair value of asset 1 on the basis of the above information. Okay, so investment 2 is receivable in 1 year and investment 3 is receivable in 2 years. And this is 800 receivable in 1 year. So which is more closer to the one? Investment 1 we want to value but don't have a market price. So we have to use a comparable one. So should I make use of investment 2 or should I make use of investment 3? Okay. So comparatively, we know we can make use of investment in year 1 because we are going to receive after year 1. So investment 2 is more comparable. So let me write it. We have investment 1, market price we don't know. We have investment 2 and we have investment 3. Investment 2 market price 1083. Investment 3 market price 700. 566. And receivable, right to receive. You receive rupees 800 after year 1. And receive 1200 after year 1. And rupees 700 after year 2. So which is more comparable in these situations? Because this valuation we are doing is also after year 1. This is also after year 1. Therefore, I will say investment 2 is more comparable, is more appropriate. So what we should use? Use this interest rate and apply it on valuation of investment 1. So what is the implied rates? IRR, in the sense if I use a simple concept, present value is 1083, future value is 1200 for a period of 1 year. What is the rate of interest? Since it's only 1 year, you can use simple interest also, you can use compound interest also. 1 year, so f equals to p into 1 plus r to the power of n. Future value 1200, the present value 1083, it goes denominator, okay, that's why I've taken left side. 1 plus r to the power of n, that is 1 plus r only. So simplify and subtract 1. So r equals 1200 divided by 1083 minus 1, 0.1080 or 10.8%. This 10.8% will apply it on this now. So this receivable after year 1, we should discount by 10.8%, right? So this is after year 1, you're going to receive 800, and what is the value today? 800, you're going to do a present value. So cash flow multiplied by discounting factor will give you present value. So cash flow is 800 multiplied by discounting factor at 10%. Discounting factor at 10.8%. Or divided by 1 plus r, or 1 by 1.108. 722. So that's how you are going to value the investment 1. If investment 2 was also not there, then we'll take investment 3. We'll compute the implied rate for year 1, year 2. In your SFM, you would have learned forward rates, YTM. Using those concepts, you will calculate the interest rate applicable for first year, and that you discount it, that rate you discount. That's how you are going to value investment 1. Hope you have taken down. Okay. What institute tells you is also same thing. You can just read through it. But let me read the last paragraph. Alternatively, in the absence of available information for investment 2, if investment 2 data was not there, not required for exam, only for concept purpose, the 1-year market rate could be derived from investment 3 using build-up approach. In that case, the 2-year market rate indicated by investment 3 would be adjusted to 1-year market rate using the term structure of risk-free yield curve. Additional information and analysis might be required to determine the risk premiums for 1 year, 2-year assets are the same. If it is determined the risk premiums for 1 year and 2 year are not same, the 2-year market rate of return would be further adjusted to that effect. Seems made complicated, not so much. If you remember SFM concept, the difference between forward rate and yield. When I calculate from year 1, year 0 to year 1, year 1 to year 2, year 2 to year 3. They are called as forward rate of year 1, forward rate of year 2, forward rate of year 3. But if I do from year 0 to year 2, that's called as yield of year 2. If I do from year 0 to year 3, like an average, that is year 0 to year 03, give me one rate. That's called as yield of year 3. So here we want to value investment 1. Investment 2 is appropriate because same having maturity period. But if investment 2 don't have market data, then we go for investment 3, which has a different life. So investment 3 has the receivable after 2 years, so you'll get 2-year rate, that is 2-year yield you get. So they said you have to check whether first year yield and second year yield are having same risk appetite. If not, when it will not, after 1 year you're expecting the rate of interest to change, risk-free rate might change, a premium might change, your expectation. So in that case, your yield for 2 year will be different. Forward rate for year FR1 will be different. FR2 will be different. Forward rate means year 0 to year 1. And then year 1 to year 2. FR1, FR2. From year 0 to year 2 means yield. So when you calculate directly for year 2, you get yield of year 2. But you have to take out the FR of year 2, you get FR of year 1. If you apply SFM concepts, listen to me these wordings once more, you'll be able to understand. Anyway, the last paragraph was not required for exam. Just read it for your reference purpose. You can also read through it. Okay. Okay, so as I told you, today is a very short video. I just finished only standards, Ind AS 8, Ind AS 10 with no problems were there, and Ind AS 113, only one problem was there. So we'll stop at this point today. Tomorrow we'll take up next set of standards, which is Ind AS 20, government grant, and if time permits, then Ind AS 102, that is share-based payments. So that will be the target for tomorrow. Till then, take care. Bye-bye.